we are witnessing perhaps the most audacious bet in modern finance. They'll print until reality breaks us. These are not headlines from fringe blogs. They're the echoed warnings of Stanley Druckenmiller, Michael Burry, Ray Dalio, and Warren Buffett. Druckenmiller recently warned the U.S. is spending like drunken sailors, and that the mounting debt will squeeze the future. Burry has long decried speculative excess built on debt, calling it the greatest wealth transfer in history if left unchecked. Dalio warns that unsustainable debt doesn't vanish, it morphs. It is repaid in weaker money. Buffett has reminded us, you can't keep printing money without consequence. And now, these warnings collide with a bold claim. The U.S. may be preparing to devalue $37 trillion of its debt by quietly converting it into stablecoins, manipulating gold, and shifting the burden onto savers, creditors, and global investors. If this is more than rhetoric, it could be the most significant engineered wealth transfer in modern history. That is the question we explore today. To grasp the scale, let's walk through the numbers. As of 2025, the U.S. gross national debt exceeds $37 trillion. This comprises 1. Debt held by the public, which includes treasuries sold to investors, institutions, and foreign holders. 2. Intragovernmental debt. This includes obligations the government owes to itself. For example, trust funds. Both debt profile translates to roughly $110,000 per person or $280,000 per household. Just a few years ago, projections from the Congressional Budget Office expected the $37 trillion milestone to occur in 2030. But soaring deficits, stimulus bills, tax cuts, and compounding interest pushed that curve forward. Behind the large numbers lie profound implications. Here are some questions. First, who holds this debt? Secondly, who will demand repayment? And lastly, what if the United States fails to repay it in full? Now, here is a dramatic twist. Anton Kobiakov, a senior advisor to Vladimir Putin, recently accused the U.S. of preparing to shift its $35 to $37 trillion in debt into the realm of stablecoins, effectively devaluing it rather than repaying it. He argues this process is not an evasion. It's a stealth reset. According to his narrative, the U.S. may convert traditional debt claims into digital dollar-backed tokens. Simultaneously, gold markets may be managed or muted to avoid sudden inflation revelations. The net result: creditors receive tokens whose real value is less than the original debt, shifting the cost onto them. In essence, Kobiakov says America is attempting a modern version of Nixon's 1971 gold abandonment, but with crypto. Critics call this notion speculative or even propagandistic. Still, the symmetry with historical debt resets makes the accusation hard to dismiss outright. Let's listen to the voices that have been ringing alarm bells for years. Voices that lend weight to what may otherwise seem like outlandish claims. First, Stanley Druckenmiller has repeatedly warned that U.S. fiscal policy is unsustainable, that rising debt is crowding out growth, and that current spending levels are irresponsible. He's even publicly criticized seniors needing to take a cut in benefits, citing fiscal strain. In 2025, he's taken sizable short positions in long-term treasuries, betting on interest rates going higher. Next is Ray Dalio. Ray frames crumbling debt cycles as among the most significant risks to global stability. He warns that political impasses, environmental strain, and debt complexity will force financial upheaval in the near term. Next is Michael Burry. Long ahead of the curve, Burry has decried speculative excess and systemic risk. He sees massive debt as the ignition switch for wealth destruction among average investors and wealth extraction by institutions. Next is Warren Buffett. His core message is that perpetual money printing is a silent tax on savers, eroding the value of hard-earned capital. These are not alarmist pundits. They are financial titans whose portfolios and reputations depend on seeing risk before it strikes. If they are concerned that debt may not be repaid honestly, we ignore at our peril. How could a strategy like this converting debt into weaker digital liabilities work? Imagine the U.S. has a credit card bill of $37 trillion. Paying that back dollar for dollar is almost impossible. So instead of saying, we can't pay, the U.S. finds ways to make that debt worth less quietly. Here's how. First, keeping interest rates low, financial repression. But let me break this down. Imagine banks making you accept a tiny interest rate on your savings, even when inflation is high. Your money is safe in the bank, but every year it buys you less. Meanwhile, the government continues to borrow at low interest rates, solving its problem but creating a new one for you. Secondly, inflation. That is, the silent tax. If the government owes you $100, but inflation erodes 20% of its value, when you finally receive that $100, it will only buy you $80 worth of goods. The debt is technically paid, but in reality, you lost value. Another is turning debt into digital dollars, stablecoins. Imagine instead of handing you a $100 bill, the government gives you a digital coin worth $100 on paper. Over time, they can control, dilute, or restructure how these coins work. You still have your money, but its power is weakened. Controlling gold prices. Gold is like the truth detector of money. If gold rises, it's a signal that the dollar is losing value. To keep people calm, governments may try to control gold prices, so the inflation story isn't obvious. Shift into hard assets. While all this happens, investors flee to assets that hold value, such as gold, land, oil, Bitcoin, and stocks. The rich, who already own these, get richer. Everyday savers, who mostly hold cash and bonds, lose. In short, the government shrinks its $37 trillion tab not by paying it, but by making the dollars it owes worth less. Here's where the wealth transfer happens. The winners are people who own tangible assets, such as gold, property, farmland, energy, and even cryptocurrency. Second is the governments that issue the debt by repaying with cheaper money. Third are wealthy investors who anticipated this and purchased assets early. While the losers are 1. Regular savers who kept money in cash or bonds. 2. Pension funds and retirees rely on fixed income. Then, foreign countries, like China and Japan, that hold trillions in U.S. treasuries. Think of it like this. It's as if someone promised to pay you back with 10 pizzas. By the time you get them, they're still 10 pizzas, but they're much smaller slices. On paper, you got what was promised. In reality, you got less. That's how trillions quietly move from ordinary people to the government and the asset rich. Of course, this isn't a magic trick with no consequences. Here's why the plan could backfire. Market may catch on. If investors suspect the U.S. is weakening the dollar, they'll demand higher interest to lend. That makes debt more expensive, not cheaper. Foreign pushback. Countries like China or Japan could dump U.S. Treasury securities, sparking chaos in the bond market. Other nations may accelerate plans to move away from the dollar in global trade. Inflation gets out of control. If inflation rises too fast, people lose faith in the dollar altogether. That could spark panic, like in Argentina or Turkey. Political fallout. Retirees, pensioners, and middle-class families won't stay quiet if their savings are silently eroded. That can trigger political instability. Systemic risks with stablecoins. If the U.S. attempts to integrate digital dollars and stablecoins into debt management and those coins fail or lose credibility, it could trigger a financial crash rather than a smooth reset. So while debt devaluation is a possible strategy, it's not foolproof. It could either be a controlled shift of wealth or a financial firestorm that the U.S. struggles to contain. The question is not whether the U.S. can repay $37 trillion. We already know it can't in absolute terms without inflation or economic collapse. The question is, how will it choose not to repay it? If the path is via engineered devaluation, we may be in the midst of the greatest wealth transfer ever, from savers, bondholders, and foreign creditors to governments, asset owners, and global money managers. The voices who warned us, Druckenmiller, Burry, Dalio, and Buffett, are not alarmists. They are sentinels. Now, you must be alert. Watch for signals. Yield curve control, caps on treasury interest, digital dollar mandates, stablecoin integration, inflation above the rate targets, gold suppression or manipulation. Position early. Hold tangible assets, diversify globally, reduce exposure to fixed, income risk, and never mistake nominal promises for real value. This is not a forecast, it's a call to see the playing board. Whether this scenario becomes history or horror depends on policy, markets, and resolve. But one thing is sure. In the war on debt, nothing is truly safe. If this video helped you understand the world a little better, like, subscribe to Micro Money, and share it with someone who loves finance and economics.